Welcome to Money Sense, where we go beyond the numbers to help Canadians design a wealthier life. With host Brent Laux and trusted experts Kevin Hegedus and Andrew Roddick, partners at PWM Private Wealth Counsel and portfolio managers with Q Wealth. Whether you're preparing for retirement, designing tax-efficient income, or planning for future generations, financial decisions can be overwhelming. With a spotlight on pension-style investing strategies that prioritize long-term stability, Kevin, Andrew, and the PWM team will share their insights and perspectives to help you protect what you've worked a lifetime to build. Because effective financial planning should feel like laying a strong foundation. This is Money Sense.
Welcome to our Money Sense program. Brent Laux with you, joined today by Kevin Hegedus, portfolio manager with Q Wealth Partners, and Kevin, of course, the founder of PWM Private Wealth Counsel. Kevin works with business owners, professionals, farmers, and retirees all across Western Canada. Kevin, good to see you. Welcome back to the program.
Hey, it's great to be here, Brent.
We've got an interesting program today, and something that's always on the minds of investors, and maybe even more so these days with what's going on in the world. And that's a market crash.
Well, that's right, Brent. Imagine waking up one morning and realizing 40% of your life savings has vanished. And not because you did something reckless, not because you were chasing some sort of scam, but simply because the stock market did what it always has done from time to time. Now, this isn't a hypothetical fear for many investors. It's actually a real anxiety that we're seeing. We're hearing a constant talk about market bubbles, artificial intelligence hype, about stretched valuations, and these warnings that the next big crash could be right around the corner. So today I want to talk about how investors can actually survive a market crash emotionally, financially, and practically.
Let's start with the big fear we all have. A lot of everyday investors seem convinced that 2026 or sometime soon is destined to be the year everything falls apart. Are they wrong, do you think?
Well, I don't think they're wrong to be cautious, but they are wrong to think that a crash is somehow unusual or a sign that the system is broken, right? So, market corrections and crashes are normal, and they're the price that we pay for long-term growth. And if you look at history, declines of 30% or more, they happen roughly every 10 years. Drops of 40% happen every few decades. And even the truly terrifying 50% declines, like the dot-com bust or the 2008 financial crisis that we went through, well, they're going to happen from time to time, and they're going to happen again in the future, Brent.
So the real danger then isn't the crash itself?
Yeah, I think the real danger is how people react to that crash.
One of the points that really stands out is how emotionally hard losses can be. Seeing your account drop day after day feels unbearable for a lot of people.
Yeah, it really does. And there's a biological reason for that. Humans are hardwired, right? We feel losses about twice as intensely as gains, and that's called loss aversion. So think about that for a second. To feel as good as making $100, you actually have to avoid losing $200. Now, this can lead to some poor decisions without even realizing it. So when your portfolio is down 20, 30, 40%, your brain is screaming, do something, make it stop. But the uncomfortable truth here is that those losses are not real unless you actually sell.
Yeah, that's a tough message to hear, though, when everything on the screen is red, right?
It really is, Brent. But and I've said this before, everyone knows it. Panic selling is the one action that can permanently damage your financial future.
Okay, let's put some numbers on this, Kevin. Let's say someone has $1 million portfolio and the market drops 40%. So they're suddenly staring at $600,000 in their portfolio. That's devastating for people.
It is, Brent, and that's why the conversation really matters before the crash and not during it. 40% drawdown feels catastrophic, but historically, for a diversified equity portfolio, it's always been temporary. And the investors who survive aren't the smartest. They're not the ones who have predicted that crash correctly, but they are the ones who didn't abandon their financial plan.
Now, I know in talking to you over the years, one of the key strategies we've talked about is dollar cost averaging. It sounds rather boring, but the math, you'd have to admit, is compelling, isn't it?
Yeah, you're right, Brent. And it is boring, but it does work, right? Dollar cost averaging, simply investing a fixed amount of money at regular intervals, regardless of what the market is doing. And most people think investing during a crash is reckless, but Historically, periods following downturns, they've actually shown to be quite good and they've shown higher returns.
Okay, can you give us an example of that?
Sure. So let's say someone had $100,000 invested back at the market peak in 2007. Then the financial markets hit, the credit crisis hit, and the markets fell 50%, a little bit more than 50%. Now imagine that same investor kept investing $500 a month every single month through the entire crash. That portfolio would have recovered more than a year sooner than the market itself. And by the time the S&P 500 finally clawed back to its old high, that investor would already have been ahead by about $10,000, Brett.
So the crash actually ended up helping them,
It did, and that's because, we're buying assets at some deeply discounted prices.
but most people don't do that, do they?
They don't, right? And I guess that's the tragedy. People say they want bargains. We hunt for deals on groceries, on flights, on electronics. But when stocks go on sale, a lot of times fear takes over. So instead of seeing the opportunity, what do we see? We see danger.
Kevin, before the program, you talked about an article that quoted Warren Buffett during the 2008 crash. In that article, Buffett said there was a fire sale on stocks.
Yeah, exactly. No, and when we look back at history, it's easy to say that that was a no-brainer. We should have been buying stocks at that point, but it was a hard thing for most people to do. And one of my favorite quotes, and this is in the depths of the financial crisis in 2008, Warren Buffett said, "Crashes allow investors to buy a slice of America's future at markdown prices." And he was absolutely right. Over the next decade, the S&P 500 actually tripled, but most investors didn't participate fully in that recovery because they were sitting on cash. They're waiting for things to quote unquote feel safe again.
Okay, so if you had to boil it down then, Kevin, for one rule for people to survive a crash, what would it be?
I would say stay invested, and that doesn't mean ignore risk, Brent. It means don't make irreversible decisions in moments of panic. Every major market decline feels like this time it's different. And every time investors who stay the course, they've been rewarded over time. We can't forget that.
And you mentioned time. That's where we move on to our next topic here, and that is retirees, because this is where fear is most justified, I guess, isn't it?
You're absolutely right. And, a market crash is obviously very different for a 35-year-old than for that 70-year-old who's drawing income from their portfolio. And this is where the something called sequence of returns risk really comes in. So if you're withdrawing from your portfolio during a market downturn, you're locking in losses that can permanently impair your ability to recover in the future.
Okay, so what's the solution then?
Well, the big thing is planning, but make sure you do this before retirement. You're going to need layers in your portfolios. Let me explain this. You're going to need some cash and some short term investments to create income and also for some near term spending. You're going to need a portion of your portfolio to be invested in defensive and non correlated assets. I'm going to talk more about that later on in the show. And then you're going to need some growth assets for that long term inflation protection. That way, you're not forced to sell equities at the worst possible time. And, again, I've talked at length on the show about building non-correlated assets into your portfolio. And this is crucial, especially for our retirees out there that are relying on that monthly income from their investments. And, the private debt fund that Q Wealth has built has returned 7.5% over the last 5 years. Now, over the last 5 years, it's been some pretty crazy times with the markets, with the economy. But let's go back to 2022. We're on the back end of COVID. We had major supply constraints. It was hard to get a vehicle back then. Heck, it was hard to get a set of patio furniture, if we remember. Global stocks that year lost 18%, and that also gave rise to inflation. And we had one of the fastest runs up in inflation in 50 years. The Bank of Canada actually raised interest rates 7 times that year. And when interest rates go up, Brad, the other asset class that goes down is bonds. So that safe bond investment that was supposed to provide safety and security in our portfolio, it lost 11% that year. Our private debt and credit fund had a positive rate of return of 8.2% in 2022.
Give us an example of how this can affect someone that's retired and they're relying on income from their portfolio.
I sure can. So let's look at two retirees. So let's say they both have $1 million and they're going to earn an average rate of return over the next 10 years of, let's say, 6%. But here's the difference. Okay. So investor A experiences some bad markets in the first few years in retirement. Investor B experiences those same bad years, but much later when they're taking out the money. So even though the returns of these two investors were identical, investor A could actually run out of money years earlier than investor B.
So timing really does matter.
Yeah, it matters enormously because you're withdrawing income while markets are down. What you're doing is you're selling units off at lower prices, and again, that permanently reduces your portfolio's ability to recover.
Okay, are you then suggesting, Kevin, that anyone who couldn't survive a 40% drawdown should be rethinking their exposure?
Exactly. A 40% if a 40% decline would, let's say, derail your retirement, it would cause you panic or force some lifestyle changes for you. I would say that your portfolio is misaligned with your reality. Got to remember here that risk tolerance isn't about what you hope to endure, it's about what you can actually stomach. And this is really one of the key reasons why Andrew and I, in partnership with Q Wealth Partners, created the Q Wealth Strategic Assets Fund Rent. And this is used as a sleeve in all of our portfolios. It can range anywhere from 6 to 15%, depending on the model. And this sleeve is actually made up of non correlated investments, similar to what you'd find in a pension plan. And and pension plans have to have these types of investments because they have people relying on that monthly income every single month. So just think of the Canada Pension Plan as an example.
Yeah. I know that you've talked about this in the past. Give us a bit of a recap on some of the investments that you're holding in this fund.
Absolutely. So remember, this is not a stock market investment. Its purpose is to lower the risk and the volatility in your portfolio, but also to allow you to access different investments when your equities may be in correction territory. So we own things like music royalties, we own storage units for real estate, we own farmland, infrastructure investments. So those are things like cell phone towers, fiber optic networks, cargo terminals, laundry machine contractors. We even own car washes and we actually own SpaceX in our portfolio. Now, another sector, Brent, that has historically performed well in periods of inflation when stocks correct is commodities. So this is going to include owning things like precious metals. We all know what happened with gold and silver in the last couple of years, but owning coffee, cocoa, lean hogs, live cattle, aluminum, and of course, we own oil and gas, just to name a few. And if we went back and we looked at the first quarter in 2022, when inflation hit and stocks dropped, commodities really performed well. And Brent, we've actually built all of these ideas into one fund. So this is a very unique thing, and it's something that we're very proud of. And these investments are what we refer to as dry powder. So these are things that our clients can access when equities are down, or even if equities are down and they just want to use this to rebalance their portfolio and buy stocks when they're on sale.
And we should also mention, there's an economic reality going on here. Market crashes just don't happen in isolation, do they?
Yeah, you're right. Bear markets often spill into the real economy, right? So spending slows, credit tightens, businesses tend to pull back, and unfortunately, people lose their jobs. There's a recent Scotia Bank report that estimates that a 40% drop in the S&P 500 could lead to about 70,000 job losses in Canada today.
So I guess the people best positioned to invest during a crash then are those who are able to stay employed.
Yeah, I guess, liquidity plus income equals opportunity, right?
And you see at that same time, a lot of nervous investors then flee over to cash, right?
They do, and I guess for a lot of people, cash feels safe, right? And cash does have a role in everyone's portfolio, but long term, cash is almost guaranteed to lose purchasing power. Historically, as we know, equities have outperformed cash by a wide margin over long periods, and sitting out of the market because you're scared often does more damage than riding through that volatility.
And I know earlier you used the analogy of a fire drill.
Yeah, you don't design a fire escape plan when the building's on fire, right? You prepare for this in advance. So you need to understand your risk. You need to structure your portfolio properly. You need to know where income is going to come from, and you have to decide in advance how you're going to react. That way when the smoke fills the room, you're executing a plan and you're not running it for the door and panicking.
So a good financial plan isn't about just predicting the markets.
Exactly. We don't predict crashes. We're going to assume that they're going to happen. And a good plan should answer, first of all, how much can I lose temporarily and still be okay? It should also answer, where does the income come from during a downturn? And then what assets are going to be sold first and which are going to be left alone? Kind of that dry powder that I referred to earlier. And that's really how you survive emotionally and financially, Brent.
Interesting topic that we're on this week on our Money Sense with Kevin Hegedus, a market crash. They're going to happen. How do you best survive it? What are you hearing, in the world, everything that we're seeing going on, oil, war, you name it, political side of things. What are your clients saying to you in these rather tense times?
Well, when I look back over the last year, it's been a year ago that Trump introduced the tariffs, or I call them the tariff tantrums. And we actually saw the US stock market correct 20%. A lot of people don't realize that, but that's how much the market went down last April when tariffs hit. Um, and then recently, with obviously Iran and the volatility that we've been seeing in the markets, clients are nervous, right? They're wondering what's going on. They're concerned about their portfolios. What I'm finding in the meetings that I'm having is, getting back to showing people how much they have in that dry powder. And I'm talking about my retirees, right? So someone comes in, they've got $1 million portfolio, they're taking out $3,000 a month as an example to live off of. They're surprised to know that they have a year, 2 years, 3 years, maybe 4 years, depending on the model, of dry powder that they could draw that $3,000 out of their portfolio every single month without having to touch their equities. And that it means so much to them, and they get it, right? They understand we can't control what's gonna happen to the stock market, but if we're not relying on our equities to generate that income, we're not selling things off at a loss. Now they know if we get into a bear market, which we could be in a bear market for 2 years. No one knows what's gonna happen, but you wanna make darn sure that you have, that 2 years or 3 years of dry powder to generate that cash flow, so you're not gonna be forced to sell those equities off at a loss if and when the time comes.
Okay, for our listeners, just some final thoughts on our topic this week of surviving a market crash.
Yeah, again, I guess I would say that, market crashes are inevitable, right? But panic is optional. Investors who succeed long term, they're not the ones who are avoiding every downturn, but they are the ones that, as I mentioned earlier, stay invested, keep contributing. So if you're a younger person out there, keep putting that money away every month. Treat downturns as an opportunity. Remember, things are on sale, try and take advantage of that. And then also align your risk with reality. And if you're retired and or nearing retirement, make sure that you know how many months of those dry powder investments you have in your portfolio. And by knowing that, that's going to allow you to sleep better at night. We got to remember that volatility is simply the admission price that we pay for that long-term wealth that we all want. And I guess, just with that, I'd say if today's discussion made you feel a little bit uncomfortable, it's probably a sign that it was worth hearing. So thanks for tuning in. And got to remember, sooner or later, the market's going to test all of us, right? So how prepared you are will matter far more than when the next crash is gonna happen. We can't predict that. And I guess if you'd like to meet, have a second opinion, look at the risk and return of your current portfolio. We'd be happy to do that. We've got some great software that we actually measure people's portfolios, not only from a return standpoint, but we talk about standard deviation. We can measure that for someone. Give our office a call, 306-975-9500. Go to our website at pwmprivatewealth.com.
Kevin, I'd say this has been a grounding and reassuring conversation on the program. Thanks so much for joining us, Kevin.
My pleasure, Brent.
That's all the time we have for our Money Sense today. Tune in next week for another episode of Money Sense.
Thank you for joining us for Money Sense, where we explore meaningful conversations about money, life, and the choices that shape them both. At PWM Private Wealth Counsel, they're here to help you build a life as solid as the financial plan they've built for you. And most importantly, give you the confidence to know you're going to be okay. Financial planning services are offered through PWM Private Wealth Counsel. Portfolio management services are provided by Q Wealth, a registered portfolio manager, investment fund manager, and exempt market dealer. PWM Private Wealth Counsel is an owner and partner in the Q Wealth Partnership, where money meets meaning.